Hey everyone, welcome back to the channel. Today we're talking about something that a lot of first-time home buyers might not know about, but it's super important if you've got or are thinking about getting an FHA loan, mortgage insurance premium, or MIP for short. If you're sitting there wondering, what's MIP? Why am I paying for it? We're gonna break it down, keep it simple, and I'll share some tips on how you can reduce or even eliminate MIP altogether. All right, so first things first, what exactly is MIP? If you have an FHA loan or are looking into getting one, MIP is this extra insurance that's attached to your mortgage. Now, this insurance isn't for you, unfortunately. It's actually insurance that protects your lender. And here's why. FHA loans are designed to help people who might not have a huge down payment or perfect credit. Basically, the FHA, which is the Federal Housing Administration, is taking on a bit more risk by helping people with these loans. And MIP is there to protect the lender in case you can't make your payments. Now, think of it as the FHA's way of saying, hey lenders, we've got your back if things go wrong. And because the FHA is making it easier for you to get into a home, the trade-off is that you've got to pay MIP as part of your loan. So there are two types of insurance payments as part of an FHA loan. An upfront mortgage insurance premium, UFMIP, and an annual premium, MIP. The upfront premium is usually around 1.75% of the loan amount, and you either pay it when you close on your home or you can roll it into your loan. I have another video that goes into more detail about this, so be sure to check that one out after this. But the second part is what we're focusing on today, the MIP. MIP is broken down into monthly payments and added to your mortgage bill. So it's not something you have to pay for separate. Now, how much you pay depends on things like how much you borrow, the size of your down payment. If you've already purchased and put 10% or more down, or if you're going to be getting an FHA loan and will be putting more than 10% down, then you will have MIP for 11 years. If you put less than 10% down, you will have MIP for the life of the loan. That's 30 years unless you refinance into a conventional loan or sell the home. So how do we get rid of this, or at least how can we lower it? Well, the main way to do this is refinancing. If you have built up at least 20% equity in your property, meaning you've paid down a good chunk of your loan or your home's value has increased, you can refinance into a conventional loan and not have mortgage insurance. But if you don't quite have 20% equity, you can still refinance into a conventional or another FHA loan. Remember how earlier I mentioned that the amount you pay for mortgage insurance depends on things like how much you borrowed and the size of your down payment? Well, if you can borrow less with the refinance, since you will have already made payments on the principal of the loan, and if you have more equity in your home, you can most likely reduce the amount of mortgage insurance you will have to pay each month. Or if you do a refinance into a conventional loan without 20% equity, you can contact the lender once you get to 20% equity and request the mortgage insurance be removed. And after you have reached 22% equity in the home, the lender will automatically remove the insurance. You don't have to worry about having the mortgage insurance necessarily for 11 years or the life of the loan. Your lender can compare rates and what you would pay monthly in mortgage insurance to see which would be a better option, refinancing into a conventional loan or into another FHA loan. Now, one thing to keep in mind though is refinancing isn't free. There are closing costs involved. So make sure the savings from eliminating or reducing the MIP outweigh the costs of refinancing. Another option, although it might not be for everyone, is to make extra payments on your loan. This helps you build up equity faster and could get you closer to that 20% mark where you can refinance into a conventional loan without MIP. And you could pay a little extra each month, make one extra additional payment each year, or if you get a bonus at work or a tax refund, you can throw that towards your mortgage too. It's not a quick fix, but every little bit helps in the long run. Now, MIP might feel like a burden, but it doesn't have to be forever. There are ways to reduce or eliminate it, whether it's through refinancing, increasing your down payment, or paying off your loan faster. There are options. And hey, the sooner you can say goodbye to MIP, the more money you have in your pocket every month. So if you have any questions about FHA loans or want to know more about refinancing, drop them in the comments or reach out to me directly. And if this video has helped clear up some of the confusion with MIP, give it a thumbs up and don't forget to subscribe for more tips on home ownership. Thanks so much for watching, and I'll see you next week.